Welcome to Behind the Booking, an interview series where I, Josh Wade, sit down with entertainment industry professionals to uncover the business behind the bookings. Brought to you by the Booked Up app and the Booked Up Believers community, helping actors stay booked up without working a 9 to 5. Today's guest is someone every performer needs in their corner. He's a certified public accountant and owner of his own tax firm with over 10 years of experience, helping creatives and performers stay financially organized and tax ready. He specializes in working with business owners, athletes, and entertainment professionals to help navigate tax deductions, manage multiple income streams, and plan for long-term financial success. Please welcome my brother, Corey Patterson.
Hey, what's going on, man? Pleasure.
What's the deal, man? I really appreciate you coming on. I think this is going to be very special. There are a lot of performers that really just don't understand taxes at all. And not just performers, I would say the general public doesn't really understand taxes as a whole. So this is gonna be really, really good. I'd like to start off the interview by asking the question, what inspired you to become a financial accountant? What is it about working with people in the entertainment industry that you enjoy so much?
Um, it's actually a simple question. I wasn't really trying to be a financial accountant. I went to school. I played college basketball, and when you're there, when you go to school, you can't just go to school for basketball. So you got to like study something while you're there. So while I was there, I decided like, oh, let me pick up accounting because I knew enough to know that accounting is like the language of business. So I was like, all right, well, let me pick up the language of business while I'm here because I might hire somebody for this down the road, but if I understand the language, I can properly oversee whoever I hire to do that particular thing. Or if I want to open up my own practice, I can do that. Or if I want to go to corporate America and work in the back office somewhere in corporate America, I can do that as well. So I appreciate the level of optionality that the accounting degree afforded me.
Yeah.
And so I went that direction. And then after understanding a little bit more about the space of academia and what it takes to like be really recognized for having certain credentials, I realized that I had to become a CPA in order for people to really respect my degree. And so that's what led me to be a CPA. And I think what I like the most about working with entertainers is it's not so much the industry that they're in, but it's the people that are in that industry. So I tend to relate to a lot of people that are in that sports and entertainment space because, like I said, being a collegiate athlete myself, a lot of those people come from athletic backgrounds and different things like that. So where we just speak the same language, and I feel like I can give them some good information in a digestible way. And then I feel like they feel comfortable enough with me with telling me what I need to do to help them move forward with whatever it is that we're working on. So I think that that's what it is.
Okay. Okay. Love that, man. So I would say maybe a week ago, I text you and I text you a picture of there was an actress on social media and she posed the question. It's funny enough, when I was trying to book you, she had posed the question. She said, please share with me why you should or shouldn't get an escort. So if you were talking to her, how would you answer that question from her standpoint of being a full-time actress in the industry?
I would start out by saying that, but when you're considering whether you should, what was her question exactly?
So it was why you should or shouldn't get an escort.
Yeah. So, I would start off with saying that the number one thing you should consider is the tax planning, right? Like that's kind of what you're looking at when you're talking about having an S corporation. And the thing that you're looking at is how much income are you grossing per year, right? Because if you're not an S corporation and you're just an individual with a company, then that means that you're a sole proprietor. And so there's disadvantages and advantages of both. But the benefit of being an S corporation is the tax benefit. But what comes with that tax benefit is that you also run into more fees in order to more fees on the compliance side in order to maintain your status as an S corporation, right? So if
Mhm.
you're not grossing enough money, it doesn't make sense for you to kind of run into these additional fees that it's going to take for you to maintain this S corporation because the money that you're saving in tax is going to be negated by the additional fees that you pick up on. So the first thing that you want to start with is how much money do I make per year? And what's that threshold for me to determine whether I should be an S corporation? And I guess it kind of varies, but I would say the sweet spot is if you're at about, if your net is somewhere around, let's call it like 30,000, 30, 40,000 net after expenses, then you should be considering being an S corporation.
Okay, okay. I know you mentioned fees. What are some fees that are attached to being an S corp or having an S corp?
Okay. So first off, just to kind of clear the air, because I have a lot of conversations with people, and in those conversations, they'll say, should I do an LLC or should I do an S corp?
Mhm.
Right? And I get it. It's a confusing thing, but the reality of it is that your LLC, you're always an LLC. The S corporation is something that you speak to the IRS about, and you basically tell them, like, for tax purposes, I want to be treated as an S corporation. I'm an LLC, but I want to be treated as an S corporation. The IRS doesn't have an LLC tax return, so you have to tell them, if you have an LLC, you have to tell them how you want to be taxed and what that tax treatment looks like. And so let's start there with what is an S corporation and how does it differentiate itself from being an LLC. So an LLC and S corporation, just to be clear, they're one and the same. Right. So you don't go out and say, I'm going to be an S corporation and then not be an LLC. Like, they're one and the same. You start with the LLC and then you make an election with the IRS to be treated as an S corporation for tax purposes.
Got
Okay.
it. Okay.
So when you do that, to go through that process, there's a lot of things that I think that people can do on their own. I think that the election to be an S corporation is a little bit more complicated. There's a form that you have to fill out called a 2553.
Okay.
I think you have about 90 days or so after your LLC is accepted with whatever state that you're in, that you're registered in.
Okay.
Um, if you do not meet that time frame, that doesn't mean that you can't be an S corporation, but there are some special things that you have to do to tell the IRS, like, hey, I didn't know that there was a time frame. Can you still kind of like retroactively approve me to be an S corporation for the year? Right. So that it gets a little bit more complicated. So on that side, I would recommend definitely speaking to a professional like myself. Um, so that's one of the fees and the compliance things that we're talking about to get started. The second thing is, when you're an S corporation, now you have to file an S corporation return. So if you're a sole proprietor, everything you do from a business standpoint falls under your personal tax return. You don't have to worry about any additional tax returns. If you file your personal tax return, everything that you do from a business standpoint is going to live on that personal tax return. When you're an S corporation, you're going to have a separate tax return, which is called 1120S. And you're going to do all of your business, your gross, your expenses, everything's going to be on that tax return. Then you're going to receive a K1. So your S corporation is going to issue a K1 to you personally. That K1 is going to go into your personal return. And that's where you're going to pick up the net income that you produce in your S corporation. So just to maintain that, that's going to be a little bit more expensive of a tax filing than if you were just a sole proprietor where everything was living on long time.
Okay. Okay. The K1, what exactly is a K1?
So a K1 is basically a summary of your income, expenses, and depreciation. Really, I guess it doesn't really have too many expenses, but it's kind of like the net profit, and it shows like what the final result of your business was, like what you did at the end of the year from a business standpoint, and if how much ownership stake you have in this company. Because right now we're speaking about an S corporation as if it has one owner, and 100% of everything that happens with that S corporation goes to that one owner. But if there was a few owners where this person has 20%, this person has 30%, and this person has 50%, then on the K1, you would see who has what percentage of that ownership of that company. And based on the percentages of ownership, they would get that allocated part of the net profit. And then that net profit and that K1 would go on to their personal return. If they had other income, W-2s, rental properties, and other things like that, that would also be on their personal return.
Okay. Okay. So a lot of performers don't receive a W-2. They receive a lot of 1099s. So what are the benefits of a actor performer having an S corp versus just being treated as just an individual? What are some benefits that they will receive by doing that?
I guess one of the biggest benefits is you get to be in control of your own fate. When you're a sole proprietor, what happens with that is that you have your gross income and then you have your expenses. And then when you have your net profit, you pay taxes on whatever tax bracket you fall into. Let's say you're in the 20% tax bracket. We're going to pay tax on your net income on that number or your net profit on that number. And then on top of that, you're going to pay 15.3% in self-employment tax, which is basically a social security tax, right? So that's going to your social security for when you retire and Medicare and stuff like that. But it's on the entire net profit. When you're an S corporation, you have a little bit more control over that process. The IRS says that you have to take a reasonable salary, but what's reasonable is a little bit of a gray area and it's kind of subjective. It's left to yourself and your tax professional to determine what's a reasonable salary for what your particular situation is. And so you're only going to pay that 15.3% in self-employment tax on your reasonable salary when you're an S corporation, which that reasonable salary is a number that you kind of chose. Versus when you're a sole proprietor, you're going to pay that 15.3% in self-employment tax on top of your tax bracket on everything that you have from a net profit standpoint. So the difference is you just have more control over what your tax destiny is going to look like.
Okay, so as an example, let's say a performer is making $100,000 a year, I guess just to kind of round it out, and they have an S corp. How do they go about separating the gross income from their net? And then if you can explain what is gross and what is net.
Your gross income is just every dollar that you buy. All right, we haven't taken any expenses away. We haven't taken anything out, and that's your gross income. The net that we keep referring to is after you add all these expenses in, let's say travel expense, let's say you have a website, marketing expense, let's say you have took some classes, that's your educational expense. Let's say you your cell phone, internet, cameras that you use for bookings and things like that. So let's say all of those expenses that we're kind of talking about now you subtract that from the gross that you kind of made throughout the year, and that becomes the net profit that we keep referring to.
Okay. So how should a performer start organizing their taxes, I guess, throughout the year to make sure they're doing things correctly? So by the time the end of the year comes, everything averages out the way it's supposed to.
So it definitely depends. The answer, everything in our space, everything is it depends, right? Because it's not a one shoe, it's not a one size fits all. Every shoe doesn't fit every person. So it depends. But to kind of answer your question kind of broadly, I would say that the best thing they can do is first they have to identify the volume of transactions. So if it's a person that has like a lot of different transactions, a lot of moving parts throughout the year, they're receiving a lot of different 1099s, they have a lot of different little expenses that are taking place. I would recommend using some type of accounting software to kind of capture that as the year is going on, like a QuickBooks. There's a few different programs that you can kind of utilize to kind of capture some of those expenses. If you don't have that volume of transactions, you can just kind of do that on an Excel spreadsheet. You can put everything down month to month. Okay, this is the amount of income that I had this month. These are the expenses that came through. And then at the end of the year, you kind of will total everything up and give them to your tax professional. But what you want to do more than anything is that you want to try to stay as organized as possible in real time. If you don't have a high volume of transactions, then I think it'll be easier for you to maintain on an Excel spreadsheet or something like that. But if you do find yourself where you have a high volume of transactions, you definitely want to kind of capture everything in some type of accounting software because you don't want to miss anything. The worst thing you can do at the end of the year is have this gross income because that's going to be the true number, right? Because we're not going to miss the gross income because you're going to receive 1099s for it. So we don't want to have the gross income that is going to follow you to the end of the year. And then we don't have the expenses because you were too busy to keep up with it. And now we don't remember what's an expense and what's not.
Got it. So, okay. So a lot of times, of course, performers are not paying taxes when they're receiving, these 1099 documents, things like that. They're not paying taxes throughout the year. So what is a good way to, I guess, make sure they're staying on top of paying their taxes? I guess maybe quarterly or semi-annually. Is that something they should be doing, which is like paying taxes throughout the year? Or should they wait at the end of the year and possibly have a lump sum of taxes?
Want to see the full interview? You can watch the entire conversation by subscribing inside of the Booked Up app. And if you're not a part of the Booked Up Believers community and you are ready to learn how actors stay booked up without working a 9-to-5, just download the Booked Up app and sign up for the Actors 9-to-5 Breakup course. Thanks for watching, and I'll catch you on the next episode of Behind the Booking.